Hi, I'm Thomas. This is the course Financial Institutions and Markets, and today we'll be discussing interest rates. Let's begin by discussing the difference between nominal and real interest rates. Nominal interest rates are typically the rates that you hear quoted by a lender or perhaps an investor, and these rates include a component that reflects inflation. Real interest rates are adjusted for inflation, so the relationship is real interest rate equals the nominal rate minus the rate of inflation. That's not the precise formula, but it's a very good estimate and a simpler formula than the complete formula. So as an approximation, we're going to use this relationship. And as an example, if we are quoted a nominal rate of 8%, in a market with inflation of 5%, then the real interest rate is the difference. 8% minus 5% equals a 3% real interest rate. In other words, the idea is that if prices are going up, you want to know what is the real return on your money, taking into consideration that when you buy something next year, the price will be higher. So in this example, if we're earning 8% on our money, the nominal rate, and prices are going up by 5%, then were we to cash out our investment after a year and use those funds to make purchases, because of the price increases in the market, we would really only have an increase in purchasing power of 3%. So that's another way to look at the concept of the real interest rate. Now let's look at theories. We're going to see two theories regarding why interest rates move, why interest rates change. In this case, the underlying real interest rate is what we're discussing. One theory is the loanable funds theory, and this is the idea of the supply and demand of funds in a market. The supply, the funds are coming from household savings and corporate earnings that are surplus, that are available for use in investment opportunities, and the demand comes from households who need additional funds, consumer spending, and business investment, businesses who don't have surplus funds, rather they need additional funds. And the equilibrium of this supply and demand is what drives the market interest rate. The lower the rate, the higher the demand, and the lower the supply. The higher the rate, the lower the demand, the higher the supply, and there is some equilibrium point at which those two meet, and that creates the market interest rate. In this theory, rates change slowly, and this idea understates the role of monetary authorities. We're saying that rates are primarily driven by supply and demand. They're not driven by monetary authorities getting involved in the market and setting rates. We'll see that in another theory, we'll take a different perspective on the role of monetary authorities. Let's look at the concept of loanable funds and the concept that we discussed earlier, nominal interest rates. Let's see what drives the inflation component of interest rates. When there's inflation, or the expectation of inflation, people tend to hang on to more cash. They like to have more cash reserves available. When cash reserves go up, what are people doing with the cash? They put the cash, some of the cash, maybe most of the cash in the bank. So it's not in hand, but it is available when they need it. So these additional cash reserves going into the bank, as we saw in an earlier lecture, this results in an increase in the money supply. When there's more money to buy the same things, assuming there has been no increase in productivity, we simply increase the supply of money, that's going to create an increase in prices in general. More money buying the same quantity of items will increase prices. And when prices go up, consumers and corporations that want to make purchases, whatever item they're buying, the prices have gone up. So they need to borrow more money to buy the same items. And so there's an increase in supply, which initially would drive the interest rate down, but then there's a corresponding increase in demand, which drives the rate back up, and the combination of those two factors produces a new equilibrium, and it's going to be a higher rate than the real rate. So once we factor in the inflation component of the interest rate, we have a higher rate. The nominal rate is greater than the real rate. Let's look at the concept of international interest rates. Interest rates aren't the same. Even if we were to take out inflation, even if we were to look at just real rates, interest rates aren't the same internationally. They vary from one country to another. And in general, we see that in rich countries, there's a high supply of investment funds available, and so interest rates and rates of return on investments in general tend to be a bit lower, simply thinking of the supply and demand concept. A lot of investors, a lot of lenders putting money out into the market for investment, and that drives down the rate. In poor countries, on the other hand, there is a low supply of investment capital. There are fewer banks, there are fewer investors, but there is a strong demand. Generally everywhere there's a strong demand for capital, whether that be for individual and family use or for business and investment use. When there's a low supply and strong demand, then rates are higher. Rates are, we could say, relative to the rich countries, rates are higher in poor countries. Now, when we see this, a question is, why don't funds move from the rich countries to the poor countries? Someone in the United States, for example, might see that they can make an investment and get a return of 6%, yet they might be able to get a return of 26% in a poor country. And the world economic system, the world financial system is relatively fluid now, so why wouldn't an investor move their funds out of the United States into a developing country to achieve a higher rate of return? Well, there are a few reasons. And some people do, some investors do, but in general, that's limited. And some of the reasons are, one, exchange rate risk. When you move your money from, say, dollars into a developing country's currency, it's possible that at the end of the investment period, when you liquidate and try and get back into dollars, the exchange rate has changed against you. In the next lecture, we're going to look at the concept of exchange rates more closely, but for now, let's just consider the scenario in which the exchange rate has moved against you, and now when you move back into dollars, you get fewer dollars per unit of the other currency than was the case when you made your initial investment. So you have a higher return, but some of that return is lost to currency depreciation. Another factor is default risk, putting money into a country where there's just a higher risk in general of companies not succeeding. And even in the United States or in one country, if we're simply looking at options within one domestic market, because default risk varies from one company to another, then the required rate of return would also vary. There's not just one rate of return in a market. It depends on several factors. So even within one domestic market, we're going to see that default risk will change the required rate of return on an investment. And in general, moving funds out of a rich country into a developing country usually means increased risk, and that increased risk increases the real interest rate required for the investment. Political risk is also a factor. You might invest in a country who later says, we're not going to let you convert from our currency to a foreign currency, or later says, we're not going to let you take your profits out of the country. Or in an extreme case, might even say, you simply can't get any of your investment back out of the country. So there's political risks that investors also take into consideration when they're deciding where to invest funds. And an interesting factor that is a reality in the global economy today is, despite the high returns in poor countries relative to those in rich countries, often people with money in poor countries actually move their money out of their country where they're familiar with the system, where they already have funds available in that domestic currency. They move their funds out of their country into developed country economies, receiving lower rates of return, but in their perspective, making a safer investment in a country that has a lower risk of inflation, a lower risk of default, lower political risk, and they see this as a better opportunity than keeping funds in their own country. So that movement of capital decreases the supply of funds in the developing countries even more, and that's a factor driving up the rates of return, the investment rates in developing countries. This concludes part 1 of the lecture, Interest Rates, and we will continue with part 2 shortly.